joining us is Yashas Bhat. He's equity analyst at LKP Securities. Yashas, good to have you on the show. Thank you for joining in. Take us through the contours of this IPO and issue first for the sake of our viewers. We know that this is completely an OFS. BSE is diluting incremental stake, and post the IPO, they will continue to hold 24% as opposed to the 50% that they hold right now. So one is that the price band is between 145 and 149, but the prospects and the valuations for this seem to be very attractive, which is why the institutional side as well is very keen and has its eyes on this IPO. So take us through the positives in this.
Hi, good morning to you all. The first thing that I would actually like to kind of talk about is the advantages that you actually have with respect to being a depository in India. The levels of penetration with respect to the financial markets in India is still pretty low. So in comparison to developed economies as well as other developing economies. So the fact that we are one of the largest young populations in the world, in combination with the fact that we have a bulging, rising middle class, and courtesy of the kind of returns that we have seen over the last 2 years with respect to the equity markets, both a combination of all of this is giving rise and giving a fillip to the kind of interest that you are actually seeing in the equity markets, and that is actually indirectly driving more people to open more demat accounts. And this company is basically a part of a duopoly, and there is quite a bit of quite a level of an entry barrier where likely you would you might just see another player coming in if the regulations that govern the depository services allow. But it's basically going to be a classic duopoly. The margins that you actually look at this business, they are spectacular. So a combination of all of this, there's going to be strong free cash flow generation that would actually happen from this business, because and the most important aspect of this business is basically the fact that it is one of the best proxies that you can ever have for kind of playing out the theme of the rising financial services and financial inclusions that you'll actually go over the next few decades. So this is a long-term structural growth story, and that is why we like CDSL.
Right. Yashas, also take us through the diversified revenue profile of the company. Now, we know that 35% comes from annual issuer charges. There's FY17 numbers. 21% came from the transactions, transaction charges, which obviously are recurring in nature, and 13% came from online data charges. So take us through, this is the top three sources as far as revenue contribution goes, but there are a whole host of other incremental sources as well. So take us through where you see a lot of positivity from, and do you see the other segments of revenue growing in the overall pie, or the annual issuer charges remaining the bulk of it? Also, there's the fee that they charge on IPOs as well, and that's also seeing some kind of traction of late.
Basically, as you rightly said, bulk of its revenue comes from these annual issuer charges that they actually have. So this is kind of an advantage when it comes for CDSL, because it helps to kind of tide a little bit of volatility that actually comes with the markets. Transaction charges would be, they would be higher when it comes to when the market is actually at a bull run, as we are actually looking for the past year or so. This transaction charge would be kind of linked to the kind of volatility that you actually see in the markets. But having an annual issuer charge as a bulk of this revenue kind of gives a little bit of comfort that revenue might actually, with respect to some stability of revenues. Apart from that, yes, the principal overhanging principle with respect to CDSL is that they have to take into consideration they can offer only those services which are incidental to being a depository. So even though they might venture into certain new depository services, like a classic example being the National Academic Depository, where they're trying to be an online database of all your certifications and all of those of your academic records. While this is going to kind of be a low value, high volume item, so you might see growth coming from there. They also have a 60% market share with respect to KYC databases and records which are required by mutual funds. So there are a lot of such small incidental revenue, but a bulk of its revenues are going to come from its mainstay depository business, and this is going to be directly tied to how the market is going to perform for the coming years. And as we all know, it is a structural growth story when it comes to the Indian financial markets. So that's where we see essentially that is the overhanging principle with respect to this company. You have to look at how this is the drive, how the securities market is going to drive the overall revenues of CDSL. It is more of a demand pull business, as we all know. So yeah, that's where we look at financial services at.
Right. What do you feel about the valuations? Because, there's also lesser precedents to go by. There are only two major established players in this space at around 17.5 to 18 times FY17 at the upper end of the price band. Do you think it's very, very attractive? And post probably the listing gains that we might see, till what level, will you be a little comfortable at 149? Assuming we go beyond 200, will that be a comfortable level still to enter?
We would not like to comment on the kind of post-listing gains where would we actually be looking at. But having said that, the valuation seems to be pretty attractive, considering again the long-term potential of this business and the fact that it is a classic duopoly, because the barriers of entry are too high for any company to kind of have an established presence. If you go to see, CDSL started after 3 years after the NSDL came into being in 1996, and that 3-year advantage that NSDL had has not been able to, CDSL has not been able to cover up as much, because 56% of market share in terms of revenue is with NSDL. So considering that both of these are almost 2-decade-old players, it would be very tough for any new depository to have an established name. Having said that, CDSL, in terms of incremental demat accounts, the new demat accounts that are being opened, they have been able to have a 60% command a 60% market share. So as a result of this, we can see that gap kind of slowly narrowing through. Coming back to the valuation perspective, out of this 145 to 149 price band, you can consider around 48 to 49 rupees actually being in the company in the form of mutual fund investments. If you actually look through the financials, you'll see that other income is a pretty significant part of the company's revenue. So considering all of that, 18 times valuation is pretty reasonable, even when we consider the risk of volatility in the earnings because of its fortunes tied to the securities markets in general. So yes, we believe that 18 times valuation is pretty reasonable.
Right. And Yashas, very finally, before we let you go, you said that the free cash flows are strong and the prospects for FCF is strong. So, speak to us a little about the dividend payout also. Do the prospects look brighter? Because, many of the people who do not, the retail guys mostly, who do not get a chunk of the pie in the IPO are left repenting. So, over a longer term time frame, given the kind of higher growth prospects and the kind of dividend payout prospects, given the strong free cash flow, does it make sense to hold on even post some listing gains?
Yeah, before we actually get into that, I would just like to highlight an important point as to why we have strong free cash flow generations. When the revenue has been growing at a double-digit tick, their operating expenses has grown at a much lower pace. The prospects of economies of scale with respect to this business are pretty high, because of which they have been able to generate very strong free cash flows and clock in EBITDA margins upwards of 50%, and net net profit margins of upwards of 46%. Now, it being a depository, it has certain limitations with the kind of businesses that it can enter into. So, as it cannot enter into anything which is not incidental to depository services, it has no option but to actually kind of give away higher dividends because of the mere fact that they would not know what to do with the money. They have around 5 billion actually kept in mutual fund investments. So as you can see, growing forward with higher growth, the extent of dividend payout would also keep on improving. If you've noticed over the last 4 to 5 years, the dividend actually has been growing from 2 in FY13 to around 3 as of now. So yes, it's been slowly growing, and the prospects of the dividend payout would be higher. So from that perspective as well, it looks like an attractive stock.